Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 206, and this is going to be the Fed Talk, and it's all about a little bit of history repeating itself. And so in this episode, I'm going to talk about the CPI that came out on Thursday, and then the PPI that came out on Friday. And what does that even mean? Like, what does the Consumer Price Index mean? What does the Producer Price Index mean? I'm going to talk a little bit about what those mean, what they are, what the results were, but more importantly, what's in store. We've got a couple more weeks here before the Federal Reserve meets, and we just had that first cut, and it's almost got that taste that was there, like there's more to come. And the Fed has an addictive personality. They've shown that. So we're going to break that down in this episode, as well as talk about what has happened every time the Federal Reserve has made that big first rate cut. All that and more in this next episode at What's Your One More. Okay, so let's get into it here. We had the CPI come out, right? So we know that's the Consumer Price Index. We've talked about this before in multiple episodes, but for all of our new listeners, and we got quite a few new ones though, so thank you for tuning in. I'm going to kind of recap what that is. So the Consumer Price Index, that is going to be what you're feeling when you go to the grocery store, what you're paying in housing, shelter cost. As the consumer, that's what we feel. But that's not what the Federal Reserve necessarily uses when they talk about inflation. They use the PCE, the personal consumption expenditures, and that's a number that's different and calculated different, a weighted average done differently. But the CPI came out this week, and then right on the heels of that, the Producer Price Index came out, known as the PPI. And that's kind of a sneak peek maybe of what the PCE is going to be, because that's what it takes, the cost of, like, for example, this amazing One More Yeti we've got here. What did it cost to make that, right? And then did that cost go up? And do they push that back down to the consumer, or does the actual producer themselves absorb it? And that's a fine line, because sometimes it can be absorbed in profitability and sometimes it's just not there. And in today's world, it's usually not there, which is why you're seeing the cost pass down to the consumer. And, we've got into the greedflation commentary in episodes before, but for the most part, you're seeing the PPI as a sneak peek as it trickles down to the PC of what it could look like. So core was up ever so slightly. Nothing to jump up and down about, but went up just a tick, right? And then the PPI was flat, right? And the core was flat as well. And you kind of had a headline that went down a little bit on that. So what does all that even mean, right? I just gave you a bunch of numbers. What does it mean? It means this. It means inflation has gotten better from the peak, right? And the way they calculate these indexes is it's over 12 months. So they average the last 12 months, and then they replace the most recent reading with the last 12 months in there. So that's how you get your index. And there's weighted averages involved of components, and we've broken that down in shows before. But the reality of it is this. There's three levels of inflation measurement, one in which the Fed pays the most attention to, which will come out in a couple of weeks. That's the PCE. But we get a look at the Consumer Price Index and Producer Price Index for inflation. And the good news is it's coming down, right? It came down from peaks at the 8 and 9%. It's down. But as my co-host, Daniel Halverson, has said so eloquently before, that once we've got it under control, you're going to have just little speed bumps of up and down measurements, because you're constantly replacing a lower measurement of inflation with a new level of inflation that may just be a little bit higher, but not necessarily on the rise, right? So it's interesting to me when these reports come out, because they're so within like a tenth of one another that they really shouldn't be market movers. And that's what we found happen this week. They're not market movers like they once were, because the expectation is so in line with what's coming in. There's nothing shocking in this report. So it doesn't really move the needle, and I don't think it moves the Federal Reserve. And we've talked about this many a times over the course of the last 6 months. What's moving the Federal Reserve is the job market. I just did an entire podcast on that and what we saw in the reports, right? You've got three reports that come in on that, the ADP, the BLS, and then you've got the JOLTS report inside there. That's what they're following, with a lot of emphasis on the unemployment rate. And, we talked a lot about that, so I'm not going to go into it again, but that's where the focus is. See, a year or 2 years ago, the focus was on inflation. And the job market was not really that of a concern, because it was so strong and it was thriving that they weren't worried about it. But, foresight tells us that if they start putting pressure on the inflation market by raising rates, the eventual product is going to be the softening of a labor market. And we hammered that home over here, and we knew that would show up. And we talked about the cycles of sometimes it takes 6 months to 16 months for that to show up, but it will show up. And that's what's showing up right now, is the tail end of that cycle. And we're starting to see the implication of those interest rate hikes they did during the time, and then also the waiting of keeping it there for so long. And in this episode, I want to talk about what happens when they start to cut it. And so after those reports came out of inflation, one of the things I think that I look for are these Fed commentaries, right? Because the Fed historically has had an issue of trying to send smoke signals to the market of what they're going to do in order for the markets to anticipate it and not necessarily be shocked. But sometimes you feel like you get this cat and mouse game from the Federal Reserve. You get these hot and cold comments, these yin and yangs, whatever you want to call it. You get the point. You just get polar opposites, and it's kind of exhausting. And I haven't seen the Federal Reserve but one time over the course of the last 18 months be on the same page, lock and step about the commentary. And this is one of those times where they were playing the cat and mouse games, because if you look at a lot of the Fed members that came out, the New York Fed President John Williams, he came out and said, hey, listen, month to month, there's wiggles and bumps in the data, but we've seen this pretty steady process of inflation moving. I expect that will continue. And he said that it's appropriate to continue the process of moving the stance of monetary policy to a more neutral setting over time. Well, we're not neutral right now. We're trying to get to neutral, right? So if you were reading in that comment, you've got the New York Fed president saying, hey, listen, we need to continue our stance to get there. That's a rate cut commentary. And if you want to kind of go, that's what he's saying. We need to continue our stance to get there. And then the Chicago Fed president, Austin Goolsbee, we know that he's extremely dovish based on his outward comments, and he's all about rate cuts. And I don't think he stopped with this. He said the overall trend for inflation over the last 12 to 18 months is clearly moving lower. He was not concerned with the slightly hotter CPI reading at all, meaning that, listen, let's continue forward on this. You got two right there kind of saying the same message. And then you get Richmond Fed President Thomas Barkin saying, hey, inflation is definitely headed in the right direction. We're good with it. And then here comes Mr. Raphael Bostic, Mr. Boom Bostic coming to the mic. And you know how I feel about him. We met him in person. He's probably not as dovish as the other ones, but he said he's totally comfortable with skipping a meeting, meaning not skipping a meeting, like not doing any type of rate cuts. And then if the data suggests that it's appropriate, we'll just skip it and not worry about it. But he's only calling for one rate cut between now and the end of the year. So the bottom line is this: the Fed is fickle. Like, the changes in their tone change very quickly, and their change in their actual monetary stance changes quickly with the market. And we just saw a hotter than normal BLS report that I broke down, as you know how I felt about that. Although I gave you a lot of reasons as to why that's not really a hot one. And I talked about what could have been and what should have been on that unemployment rate. And I think that, again, the real tell sign here was the 785,000 government jobs created on that unemployment rate on the household survey. And then the initial jobless claims that came out on Thursday, along with the CPI, they were hotter than expected. And that means more people are going to the unemployment line and getting unemployment than the week before, and then what was expected. And then continuing claims went up. And the continuing claims, the amount of people that continue to get unemployment benefits is very close to 1.9 million right now. So even though this CPI and PPI, reports were just a little bit hotter or flat, if you could say, I think you could get this cooler PCE rating come in that could emphasize the Federal Reserve has done all they need to do with inflation, and the job market is not going in the direction they want, which is why I think you're going to get that quarter cut. I think by the time we get to the end of October, it's not a question of are they going to cut. Is it going to be a quarter, or is it going to be 50 basis points again? Are we going to see that debate come up? And I think that's what we're going to be following closely here, because as that PCE comes out, and it's expected to come in cooler than expected. Matter of fact, the market's expecting a headline of 2.1%. 2.1%. Anybody recall what the target rate of inflation was for the Federal Reserve this entire 24 months that they've been harping about inflation? 2. That was the target rate. 2.1 is what it's expected to be at. I think you've achieved that, right? Now, the core is going to be 2.6, and that's really one of the numbers they look at. But the headline is what gets all of the readings, right? That's where everything goes to, is points towards the headline. But the core is what they're looking at. But at 2.6, both really good readings. And so the bottom line for inflation is, while there's these fears of it maybe reemerging, and I'm not buying into that, by the way, but in due time, things always come back, but not right now. It's been making a lot of progress, and we've done some really good things to come off the highs down to the lows. And I mean, I just said it, 2.1% is what is expected. That's good. It also tells me this, that the most significant development is in the shelter cost. It's starting to get more in line, and the market rents are starting to actually get more in line with current market rents and not that lagging market rent that we were talking about in previous episodes. And that's pretty darn good as well. So one of the things that happens when we have a rate cut like we did with the Federal Reserve is that there's this market anticipation from the consumer, from me, producer Charlie, real estate agents, home buyers, homeowners. Rates should come down. Mortgage rates specifically should come down. And anytime the Fed cuts rates, that's what the news wants you to know. That's what the media wants us all to know. And quite frankly, it should happen, right? But that's not always the immediate reaction. It does happen eventually, and inevitably it shows up. But right away, it's not always the first thing that happens. And there's a little due process that kind of takes place in the markets here, if you may. So let's go back to this. So I'm going to look at my notes here. So since the Fed cut rates on September 18th, we've actually seen the 10-year Treasury rise. And that's not unusual. It's not a phenomenon by any means, because what happens is in almost every rate cut cycle, since looking at the chart here, I'm going to have on our YouTube channel, What's Your One More? Since every rate cut cycle of 2019, there's a lot of investor psychology that takes place in this. And our friends over at MBS Highway put together this chart. You guys know how I feel about Barry and the team over there, and Dan. They put this thing together, and it's spot on. And it's going to be on our YouTube channel, What's Your One More here. But it's the Fed rate cut history and the 10-year cycle and 10-year Treasury together in one chart here. We're going to kind of talk a little bit about this. So I'm going to get a little analytical in this part. So if you're listening to the episode in your car on Apple or on Spotify, get a chance to go over to YouTube, check this out, because I think this chart, if anything, offers some sense of relief. And I think some sense of, oh, here's things to come. And the one thing I love about what Dan does over there with Barry is, man, no one's better at analytical numbers and breaking them down than the group over there at MBS Highway. So take a look at this. If you're listening, jump into the YouTube channel there. But what happens in these cycles since 2018, that investor psychology is this. Investors believe that they have a greater chance of avoiding a recession once the Fed starts cutting rates, right? So if we talk about this all the time, let's go back to that faucet, right? If you're trying to turn the faucet tighter, you don't want any water coming out of it. And the water in this case is money. And the way that you stop inflation is tightening by turning up the interest rates. And when you loosen the faucet, you reduce the Fed funds rate, and therefore more water comes out, being more money into the system. So as you're tightening the money supply, the job market suffers, the equity markets should suffer, right? That's a whole nother episode. But investors believe that you are on the verge of a recession because you've made it so tight that you're actually choking the economy. And so the Federal Reserve, when they actually loosen that spigot and put more monetary means into the system by loosening it and reducing the interest rate, they make more funds readily available to be borrowed, right? So investors say, hey, listen, when they're cutting, it's easing the concerns, right? And that causes more investors to pump money in the stock market. So what you'll see on a Fed cut, the stock market go up. And that's exactly what happened. The equities market went up on that Fed cut because of that investor psychology. But it happens at the expense of bonds, right? Because as more money flows into the equities market, the bonds market is an inversely a relationship there. It's not going to improve. It's actually going to deteriorate. And then the Fed cutting causes some fear of inflation to possibly rise again, right? Because you're putting more money into the system. You're putting more opportunities. You're easing up your monetary policies, getting closer to neutral from restrictive every time you do that. So then what happens is you have bonds sell off, right? You'll have a sell off of the bonds. Again, not helping the bond price, but this is all a temporary psychology. It's not a permanent one. It's the first thought out the gate. But here's the thing. The Fed's cutting for a reason. And the reason they're cutting is this. It's because they are seeing the economy slow down. We talked about that in the last episode. I'm going to talk about it in this episode. They know that 50 basis point cut was not just to do it. It's because they were concerned about the economy. And they still are concerned, which is why you're going to get another cut in this next meeting, because the data suggests that they need to do it because the economy is not improving. And so that's going to help bonds. It's going to help bonds and inflation come down. I'll tell you this, in each of the last instances where the 10-year yield initially rose, it eventually fell much lower. And here's the thing. I'm going to show you how much lower in this chart here. So every single time there's that initial rate cut, there's a 37% drop in the 10-year Treasury to come after that. 37% drop. And so from the first cut to the 10-year Treasury, 37% drop. And if you look at this chart, dating back to what they have on here, in September of 2024, the 50 basis point cut, the 10-year Treasury bottomed out at 3.7. Now it's made its way back up. And then it spiked 36 basis points, so about 4.06, right? That's what we've seen over the last couple of days here. The first cut from that at 37%, from that very first cycle, would be a 1.35% cut, putting that 10-year Treasury at 2.35. I told you I was going to get analytical here, but what I'm trying to get at is this. Imagine what the 10-year Treasury at 2.35 yields in the form of mortgage interest rates. And this is just history repeating itself. This whole chart goes all the way back to 1984. This could be that moment that the unlocking of some of these things that we've talked about on the lock-in effect really come undone. Because if history repeats itself, and it's hard to argue, honestly, with a 40-year history here on this chart, it will happen again. You're going to see sub-5s pop up on the board. Lock that in, that could happen. And even if you took the discrepancy in the 10-year Treasury compared to the mortgage 30-year rate right now, and you used that number, well, let's just say 2.25. We know it should be 1.5, but let's say 2.25, and you put that on top of this 235, hell, even if you put 250 on top of that, you do the math. That's a sub-5. And so I'm not sitting up here saying, hey, listen, guaranteed this is going to happen. But historically speaking, the yields have fallen 37% from the first rate cut to the cycle low. And so this is just an opportunity that I wanted to point out to you guys, because I think there is an opportunity for 5s definitely on the board. Like, you're in the 5s, that's coming up, but maybe even the sub-5. And so if you're a buyer that's anxiously been on the sideline, you've been waiting. If you're a real estate agent, you have people that are in the money in the 5s, it is coming. I'm not telling you it's coming the next cycle as far as the next Fed rate cut, but I can almost think after the election, you're going to see some massive opportunities here, and you're going to see some significant chances to get some things done that we've all been waiting for the last 24 months. Like, we have been waiting on this to happen, and now it is coming to the forefront. And I will say this, I'll have some people online that'll go, Q, I don't believe it. Like, it's not going to happen. We're not going to get back into the rates. Yeah, you're not going to get back in the 2s. I mean, give me a break, right? I'm acknowledging that. You're not going to get back in the 3s either, right? Hell, you might not even get back into the 4s, but you may see it spike down to 4.875. And I think you're going to live in the 5s here come the fourth quarter, going in the first quarter. I think that is going to be an absolute real opportunity. And I think you need to be on the sideline and ready. And I think if you're in the lending business, you need to be in contact with your current pre-approvals, your past database. And if you're a real estate agent, you need to be ready, because imagine what this looks like if we get there. Like, we've peaked and we've touched that 5.875 a couple of times over the course of like the last 90 days to 120 days. We've done it. And then what happens is, if you're in the business, you know what I'm talking about. Like, we were there for maybe a day and a half, and then, you know, as some indicator came out, and now we're back to 6.25, right? Or 6.5, something drastic changed it. But imagine when we hit that, how many times you reached out to a customer and said, hey, good news, we're at 5.875 today. And they go, I think it might go lower. And they want to wait. And then like 36 hours, it's gone. That has already happened so many times over the course of the last 24 months. Imagine if you're 5.875 for 2, 3, 4 weeks. Imagine what that looks like. Imagine the amount of people you're going to contact and what's going to be done in the form of affordability, what's going to be done in the form of people being able to unlock their lock-in effect and take advantage of the equity. It's going to be there. It's going to be there. I was speaking to a gentleman that's in the business, and I'm like, listen, I've been doing this for 23 years now. There's one more wave left in this. And what I meant by that is there's one more wave, a massive wave of probably refinances and purchases that are going to feel like musical chairs, and you're going to feel like you're COVID busy again, right? There's one more wave left. I believe it's coming in 2025. I've been forecasting 2025 of going on for quite some time now. That's been the year I think this is going to happen. And I think you're going to see a great opportunity in that. And I think inflation is under control. I think all the numbers are showing that. I think there's no reason for the Federal Reserve to hit the pause button, much less hit the raise button. And I think if you're following the commentary from the Fed president, the New York Fed president, getting back to neutral, that's getting the Fed funds rate down to 3.25. Like 3.25 is neutral. We're at 4.75 right now. So there's ample opportunity to see how we can feel we're going to be in those 5s rather quickly. So it'll be an interesting sign of things to come towards the end of October, first week of November. We're going to know more about what the Federal Reserve's psyche is and stance on that. But I do believe the cut is coming again. Again, I'll go back to 3 episodes ago. It's an addiction to them. It's the one thing they've got is raising and lowering, and they're going to continue to lower it because history shows that's what happened, as well as history shows a drop from the first cut in our favor. So we'll stay tuned and check that out. If you like what you're hearing, share this podcast. Please 5-star review us on Apple or on Spotify and leave us a comment. And then if you would, check us out on our YouTube channel for all the graphs, charts, and analytical information we just spoke about at What's Your One More with the number 1. Till the next episode, we'll see you guys at What's Your One More.
Got one more shot, I'm gonna make it. one more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.